Aggregation risk refers to the potential for multiple insured entities to suffer losses from a single political violence PV or terrorism event, particularly in densely populated or strategically significant areas. A single incident can impact numerous policies, resulting in cumulative claims. Key characteristics of aggregation risk include geographic proximity, interconnected risks, and correlation of risks. Losses concentrate in a single area affected by an event, such as a bombing in a central business district impacting nearby offices, shops, and infrastructure. An example is the 2008 Mumbai attacks, which affected multiple locations, including hotels, transportation hubs, and businesses. Losses may stem from direct physical damage, business interruption (BI), or supply chain disruptions. For example, a terror attack on a major port could halt operations, affecting local and global supply chains. Risks are often concentrated based on location, such as urban hubs, or industry, such as tourism or finance, amplifying the severity of losses. Underwriting challenges include quantifying exposure, addressing severity potential, and dealing with unpredictability. Assessing all exposures in high-density zones can be complex. For example, overlooking a densely insured urban area may underestimate cumulative losses in an attack. A high-value urban target, such as airports or financial districts, could trigger significant multi-policy losses. PV and terrorism risks are non-random and harder to predict than natural catastrophes. Techniques to manage aggregation risk include geographic information systems (GIS), exposure mapping, accumulation modeling, risk zoning, and event footprints. GIS tools visualize insured risks geographically to assess proximity and density. For example, plotting all insured properties within a 2-mile radius of a landmark helps evaluate exposure. Use heat maps to identify risk clusters, highlighting zones prone to aggregation. For example, a heat map of New York City shows high policy concentrations around Times Square. Employ models from vendors like RMS or AIR Worldwide to simulate attack scenarios and estimate losses. These capabilities include predicting losses from hypothetical events, calculating probable maximum loss (PML), and assessing tail risks. Classify areas by risk level high, medium, low based on intelligence and historical data. For instance, airports and government buildings may be high-risk zones requiring tailored limits. Study past incidents to model potential impacts on surrounding areas. For example, the Beirut port explosion's damage radius influenced future underwriting in similar industrial hubs. Practical examples include urban areas, industrial zones, and infrastructure dependency. A bombing in a financial district affects insured offices, hotels, and infrastructure within a 1-mile radius, leading to cumulative claims. A sabotage at a chemical plant causes a fire that impacts neighboring facilities, amplifying losses. An airport attack disrupts air cargo, triggering claims from logistics companies and reliant businesses. Best practices include setting accumulation limits, utilizing reinsurance, portfolio diversification, regular risk reviews, and encouraging risk mitigation. Cap exposure per event in high-risk zones to manage potential losses. Use facultative or treaty reinsurance to mitigate financial strain from aggregation. Avoid overconcentration of risks in specific industries or locations. Update assessments as new data or insured locations emerge. Support insureds in adopting robust security measures, such as surveillance and perimeter protections. By leveraging GIS tools, exposure mapping, and reinsurance strategies, underwriters can effectively monitor and manage aggregation risks, ensuring financial resilience and sustainable portfolios.